The World Bank has raised its 2022 economic growth forecast for Malaysia to 6.4% from its previous estimate of 5.5%. In its latest economic report for East Asia and the Pacific, it also said it expects Malaysia's economy to expand by 4.2% in 2023. The World Bank explained in a separate brief on the country's macro poverty outlook that Malaysia's GDP growth this year is expected to be supported by strong domestic demand, underpinned by improvements in labour market conditions. Tourism-related activities should see an uptick. Plus, the continuation of multi-year investment projects will likely provide additional support for economic growth. Still, it warned that downside risks, particularly on the external front, continue to prevail, while speculation over Malaysia's next general polls could also raise investor uncertainty. Speaking to the press, World Bank East Asia and Pacific Chief Economist Aditya Mattu said Malaysia's economic concerns include cost-push inflation and depreciation of the ringgit. He said there are two main challenges for the country in the aspects of inclusiveness of the economy and the overall economic growth moving forward. Mattu pointed out that Malaysia's economic recovery is uneven, with slower economic growth seen in the Northern Peninsula and East Malaysia regions. He said Malaysia is on the verge of becoming a high-income country, but instead of rising to that status, it is walking slowly towards it. The US dollar continued to strengthen against global currencies, including the Malaysian ringgit. On Tuesday evening, the local currency depreciated to 4.6112 versus the greenback from Monday's 4.6038. Year to date, the ringgit has sunk against the US dollar by some 10.66% from 4.1665 in December last year. The World Bank says there is no quick and easy fix for the ringgit's weakness against the strengthening US dollar, as the bulk of Malaysian traders are invoiced in US dollar. World Bank lead economist from Malaysia, Apurva Sanghi, says the only thing Malaysia can do now is to focus on the fundamental economic issues, which include structural reform. Apurva adds that Malaysia is not alone and other countries have similar numbers, but that it does speak to the power of the greenback, with 80% of global trade denominated in US dollar. Year to date, the Japanese yen has weakened 25.65%, the euro 18.31%, the Chinese yuan 12.7%, the pound sterling 25.24%, and the Australian dollar depreciated 11.98% against the US dollar. World Bank East Asia and Pacific Chief Economist Aditya Mattu says that although Malaysia does not have high foreign currency denominated debts, the country is not immune to the US's rising interest rates and the US dollar's strengthening. Mattu adds that a lot of commodities are priced in US dollar, so when the local currency gets weaker relative to the greenback, that also contributes to inflation pressure. Analysts say the outlook for cash-strapped Sapura Energy is likely to remain challenging throughout FY23 given the tough operating environment. It will be an uphill task for the oil and gas service provider to turn around its operations in the near to medium term amid heightened cost overruns in its projects. The company is also having difficulty raising funds due to a stretched balance sheet, as it is now officially a PN17 company. Hong Leong Investment Bank said Sapura Energy also faces job delivery and execution risks, as it has yet to display a satisfactory track record in recent years and is unable to secure jobs due to the strained balance sheet. The research house, which previously had a sell rating and a target price of 1 cent on the stock, has now ceased its coverage of Sapura Energy. It is understood that Sapura Energy's net debt level had continued to deteriorate to 10.3 billion as at the end of the second quarter of FY23 from 9.9 billion as at end FY22. CAF Equities also sees earnings headwinds for the company in the second half of FY23 and said that the debt restructuring process will remain an overhang for its share price. It believes the group's turnaround is still distant and uncertain at this juncture and kept its sell rating with a target price of 2 cents. Meanwhile, Public Invest Research said Sapura Energy's exposure to legacy contracts will only fall to 25% in the fourth quarter of FY23, and so project execution will remain challenging. The research house expects the group's profit margins to remain volatile and remains neutral on the stock with an unchanged target price of 5 cents per share. As at close, Sapura Energy shares were 12.5% higher at 4.5 cents for a market capitalization of 719.06 million ringgit. PT Resources Holdings, which made its debut on the ACE market on Tuesday, was the most actively traded stock on the bourse, with over 179 million shares changing hands. However, it ended its first day of trading on a modest note, closing out Tuesday at 37 cent, 1 cent higher than its IPO price of 36 cent. The highest it reached was 39 cent, which happened just after the opening bell, with 100 million shares being traded within the first 30 minutes. The frozen seafood products retailer aimed to raise 48.6 million in fresh capital from this exercise to build new cold rooms for storage to meet its growing business volume. The group was founded by its managing director Heng Chang-hui in 2012 when Heng first incorporated MO Food Mart and MHC Cold Storage. Executive Director Muhammad Latif says demand for frozen seafood is growing at an accelerated pace and there will be a lot of new opportunities for the group both locally and internationally, particularly to the Asia Pacific and the Middle East regions. He says that the group will also expand its network of MO Food Mart outlets, which Muhammad Rafsan says will help to build its reputation as a leading frozen seafood supplier. For its first quarter of FY23, PT Resources saw its net profit grow by 61% year-on-year to 7.52 million, while its top line for the same period grew 56% to 115.3 million ringgit. VS Industries' fourth quarter net profit dropped 17% year-on-year to 34.6 million from the 41.5 million it posted a year earlier, following a one-off impairment of 25.8 million on investment in an associate. Also impacting earnings was a 12.4 million impairment loss on plant and equipment. In contrast, revenue for the quarter rose 6.7% year-on-year to just over a billion as VS Industries' Malaysian segment registered a 11.2% rise to 908.3 million in delivery of orders to key customers. VS Industry declared a fourth interim dividend of 0.4 cent per share and a final dividend of 0.4 cent. These brought the total dividend for FY22 to 2 cent per share, compared with 4.2 cent in FY21. For the full year, net profit dropped 31% year-on-year to 169.7 million, while revenue slipped 2.2% to 3.9 billion from 4 billion previously. The group said its FY22 performance was affected by a lower delivery of orders to key customers amid labour shortages and protracted disruptions in the global supply chain, which affected supply of components. On its prospects, VS Industries says that consumer sentiment has turned cautious against a backdrop of inflation and fears of a possible recession. However, the group said that there are some bright spots, with labour shortages now resolved following the arrival of adequate numbers of foreign workers. It adds that the order flow from customers still remains reasonable at this juncture. VS Industries says that barring unforeseen circumstances, it expects the final performance of the group for the coming fiscal year to be satisfactory.